It's time for the Your Personal Bank Show with Ference Toth. In an era of chaos, confusion, and craziness, Ference is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ference cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ference Toth.
Welcome to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. I shared an example with a client from last week that I got more response from than on anything I've shared in quite some time. So I want to touch on this and cover some of the questions that I was receiving. What I shared last week, and if you missed it, you can always go to the Your Personal Bank websites, yourpersonalbank.com or the Your Personal Bank app and download that. Listen to any of the previously recorded shows. Each has its own topic. You can listen to anything that interests you. But what I was sharing last week is an example of a client who had a car payment of $600 a month. He was doubling up on his car payment so he could pay it off in 6 months rather than a year. And as I shared with him, he certainly could do that, understood his motivation for doing so. Wanting to pay down debt faster is generally a good thing. But I said the other option he could do is he could put the $1,200 a month into a personal bank policy, currently earning 6%, insured, guaranteed, tax-free, highly liquid. He could then turn around and borrow $600 a month from it to pay the car debt. Why would this be more beneficial for him? Well, the reason is quite simple. Typically, he's going to earn more in dividends than he's getting charged in interest. The historical average for the last 40 years has been about 2%. Now, if you pick up 2% on the money he used to borrow to pay the car off, is he not still earning interest on money he used to pay for a car? And the answer is yes. The spread, or the difference of what you're earning in dividends versus what you get charged in interest, is known as positive arbitrage or positive cash flow. It's the spread or the difference that you get to keep. Assuming he never paid back the loan, which is an option he can do. He borrows against remember, he puts some money in the policy. In our example, $1,200 a month. He borrows against it the $600 a month to pay the car payment. He's still earning dividends on the whole entire $1,200. That's the key thing to understand. He's getting charged interest on the $600 he borrowed, typically at a lower rate than what he's earning. So he's getting to keep the difference. That difference, that positive arbitrage, that spread, you get to keep every year the rest of his life. That's assuming he never pays back the loan or the funds he used to borrow against the policy. Obviously, at some point in the future, if he did pay that down, he would then get to earn the full dividend on all the money. My point is simple. Do you know of a way that you can earn interest on money you spent? And the answer is, in every case I've ever dealt with, is no. The key to understanding this is a financial literacy concept known as lost opportunity cost. And what lost opportunity cost is if you have some money that you're using to purchase something or purchase an asset or whatever that may be, what could have that money done for you if you had invested it? As I stated to this client, if you take the money and pay off the car loan, are you ever going to see any benefit from that money ever again? And the answer, of course, is no. The money is gone forever. He spent it. He has the car, but the money is gone, isn't it? This way, by keeping control of the money, allowing it to continue to earn dividends while borrowing against the asset, the personal bank policy, to then pay the car payments and pick up the difference. Now, it's earning the dividend on the entire amount. In his example, $1,200 month contribution, earning the dividend on all of that money, and then borrowing against it and getting charged interest on the portion he used to pay the car payment at a lower rate. He gets to keep the difference, doesn't he? If you're earning interest on money you spent, are you going to have more money? And the answer is absolutely. And that will continue to build each and every year going forward. Think of it as an inflation hedge. This is money that you could be earning on things that you are spending money on. This example I used was on a car payment. Now, one of the questions I got from a number of people is, well, could I use this for other things like purchasing a home or expanding my business or paying down debt, anything like that? And the answer is, of course. I have a number of real estate investor clients. I've interviewed some of them on this show who use this tool extensively. to purchase assets like real estate. They've built up policies with enough money in it to pay cash outright for homes. One of my recent interviews I did with one of my clients, they purchase homes. Oftentimes they find a deal and moving quickly is the key. And then using the policy, they borrow against it, purchase the home. They have no costs, no fees, no points, no interest rates they have to pay. So their cost of purchasing is much less than what many typical investors, real estate investors do, that is. Many of them, if they're borrowing money, they have costs and fees involved with that. If you're using hard money lenders, those fees can be quite extensive. So they don't have any, they've wiped out all of those costs and fees to purchase the home, and they can move quickly on it, oftentimes within 24, 48 hours. And then after purchasing that property, then they have the ability then to secure their long-term financing, pay back the loan, and repeat the process. I have multiple clients. One I was speaking to the other day, in the past 7 years, for example, they have repeated this process 56 times. I have multiple dozens of clients that do this and have done so for years. What's interesting is in their real estate investment business, this makes them more competitive because, as they stated, they reduce their borrowing costs significantly, and oftentimes they increase their profitability by 10, 20, 30, even 30% overall top line profit, because they've taken many of the costs and fees and transaction fees of borrowing off the table. They're more competitive than you are if you're using traditional forms of lending or hard money lending. This applies for business owners also who want to expand their business or whatever, or any person who is spending money on any item. I have another example of a doctor client of mine who understood this concept and over a period of time funded enough money into several policies over about a 5-year period to where he had enough money in his policies to then borrow against it for every expense in his practice. So he flows 100% of his income into these policies, borrows against them to pay the expenses of his practice, and he gets to keep the difference. Again, what he's earning in dividends is typically more than what his borrowing costs are. So he's getting to keep that spread, the difference. He's been doing this now for over a decade. So every dollar that comes, gross income coming into his practice, he earns dividends on, borrows against as needed at a lower borrowing cost, and picks up an extra 1, 2, 3% over the past decade on every expense in his practice. Does he have more money? The answer is absolutely. I had lunch with him not too long ago, and I can assure you he's quite happy about the decision he made to fund these policies. It's helped him in his financial position tremendously. Let me give you another example of one that you would think on the surface didn't work out so well, but ended up working out anyway. I did a review with a client. She set up her policy 9 years ago. She's gone through some financial issues, a divorce even recently. Things haven't gone so well as she would have liked. Yet she had funded this policy, and with job changes, the divorce, purchasing a new home, various different things throughout, she has flowed money into this policy each year, and each and every year has borrowed the maximum 100% of the money back out. So she's already taken out everything she's put in and then some, and the policy still has about $25,000 cash in it after 9 years of putting money in each and every year and taking out the maximum amount each and every year, her entire contribution plus. Now, show me another investment tool where you can invest in this, take everything back out each year because you had expenses or your financial situation didn't work out as expected or whatever, and you still have money left over. The answer to that is that does not exist. If you're putting money into an IRA or a 401k or an investment plan or anything, stock, bond, mutual fund, CD, annuity, I don't care, you pick, cryptocurrency, whatever. And then you each year took all the money out and you did that consistently every year. What would you have left over after 9 years? The answer is nothing. Because in a typical account, when you take money out, again, it's known as lost opportunity cost. The ability for that money to earn for you in the future disappears. That money is gone forever. That is the difference of how many of the wealthy operate versus just about everyone else. The wealthy understand lost opportunity costs. They understand if they get control of a dollar, they still want to have some benefit from that dollar, even if they then later spend it, yet they want to maintain some benefit on it. So again, by flowing money into these policies, you earn dividends on the gross contributions, the money you put in, plus as it grows over time. The money that's been contributed continues to grow, regardless of whether you take it out in the future or not. If you borrow against it to take it out to pay for items, invest in other assets, pay down debt, whatever, you still are picking up some interest. The difference of what you're earning in dividends minus the interest you're getting charged when you borrow against it. There's a gap, there's a spread, there's a difference. It's called positive cash flow or positive arbitrage. And I'll use one last analogy that I think will make sense to people. The entire real estate investment world is built upon this principle. Most people understand if you buy a long-term buy and hold rental property and you use a mortgage to purchase that property, as long as your income, rents received, exceed your expenses, your mortgage costs, and etc., the difference or the spread is known as positive cash flow. You want your income to exceed your expenses. It's a pretty straightforward concept. The question is, can you build wealth that way? And the answer is we all know that of people who have built wealth through real estate. Now, there's more to it than that. I understand building a real estate business is not as easy as buying something and sitting in the mailbox. There's more to it, but the general principle financially is you borrow money to build wealth, and your goal is to exceed income to exceed your expenses and create positive cash flow, with the tool being the property or the real estate. Your personal bank is exactly the same principle as that, except the tool is the cash and the policy. We're getting positive arbitrage on our money versus getting positive arbitrage on a piece of real estate. We're getting positive cash flow on our money, even after we spend it, versus getting positive cash flow on a rental property. It's the exact same financial principle. It's really not that complicated. And also, it's been around for a very, very long time. I've got companies that have been paying dividends consistently each and every year since literally before the Civil War. I know of families that have used this tool for generations. So it's not a new idea. It's not a new tool. It's just not a commonly known fact with the average person, which is part of the reason why I do this show, to educate. If you want more information on this or more examples of actual cases of clients I'm working with that are using this tool successfully, contact me at yourpersonalbank.com. Stay tuned to the next segment, because I'm going to address the question of how high can U.S. debt go before it creates a financial crisis.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Look, if you missed the last segment, I'm going to really encourage you to go back to my website, yourpersonalbank.com, or download the Your Personal Bank app, which is free. You can listen to this or any of the previously recorded shows anytime you want. Each has its own title. I shared some ideas with some actual examples of clients creating positive cash flow with their money, many of them for over a decade that I work with personally. So if you missed it, and I've gotten tremendous response on some of these stories I've been telling, I encourage you to go back to the website or the app and check it out. Now, one of the questions I get a lot, because we do discuss this on this show, and it's of major concern, is the U.S. debt. And the real question is, how high can U.S. debt go before it triggers a financial crisis? Now, the numbers have been put out. The U.S. debt is currently about 121% of GDP, and GDP is gross domestic product. Gross domestic product is basically what our country, we all individually as a country, earn in a year, and then the debt to income ratio. It's much like a debt to income ratio when you purchase a house and get a mortgage, for example. The total debt is about 121% of what we earn. Interest expense on that debt is currently about 22%. In other words, about 22% of revenues, total gross revenues from the U.S. government, are paid to interest on the debt. So that's where we really get into that debt to income ratio. If you've ever qualified for a mortgage, you probably know that if your debt to income ratio is over 30%, you will not qualify for that home. That's your total amount of debt. What does that mean? For example, if you earned $100,000 a year, your total expenses, debt expenses, cannot exceed $30,000 or 30%. So that would include your mortgage, if you had a car loan, credit cards, or any other type of debt for that matter. You get up over 30% of your income, most banks, traditional lending, are not going to approve you for that loan. The lending industry has figured out that if your expenses, your interest expenses, get too high, you don't have enough money to live on because you have taxes, you have living expenses. It just costs to live, and you won't have enough money to be able to service that debt. So again, if we apply the numbers, the U.S. government debt to a household, let's assume the U.S. government made $100,000 a year. The amount of debt they have is $121,000. The interest payments on that debt were $22,000 a year, or $22,000 a year. If you made $100,000 a year, can you service $22,000 a year in debt? The answer is yes. Is it ideal? No, but you can handle it. And that's where we're at right now. The problem is the spending, the deficit spending, now there's a government spending more money than they receive, continues to increase. They keep adding on to the debt, which continues to increase the interest on the debt. The second problem with interest on the debt is the government sells bonds, which are much like a CD. The government sells treasury bonds anywhere from 4 weeks to 30-year time frames, much like you can purchase CDs at different time frames, and they pay various interest rates. So if you purchase a treasury bond from the U.S. government for a certain period of time, they're promising to pay you that interest rate for that period of time. It's, again, much like a CD. It's pretty straightforward. The problem the government has is they have sold many of these CDs a number of years ago when interest rates for much of the last decade were far, far lower than they are now. Let me give you an example. About 3 years ago, a 30-year treasury sold for under 2% for quite some time. Today, that same 30-year treasury is around 4.5% to 5% even. So when that treasury that was sold 30 years ago now matures, the government doesn't pay down the debt. They just resell the debt to the new buyer at the current interest rate. What this is doing is it's causing an overall increase as this new debt matures and they resell it. The overall interest cost for the government is increasing. The combination of increasing debt and increasing interest rates, it's a double whammy. This is why they say the debt levels that we have are unsustainable if we continue on the current trajectory. One of two things need to happen for the U.S. government, just like it would for any household. If your debt interest payments start increasing too high, you have a couple of choices. One, you can increase income. That's what much of the Trump administration is attempting to do through tariff income, reshoring, manufacturing, boosting the economy, increasing the GDP. If we make more money, we can service more debt. That's an obvious solution, but unfortunately has some challenges and is not guaranteed. You're not guaranteed future income. You certainly, if you have debt, you're guaranteed to owe the debt, right? So the other solution is reduce spending. And that's where the push with DOGE and reducing waste and fraud and all those types of things are so important and so valuable. When I run into somebody who has a budget challenge, I share the same thing with them. Again, you have two choices. increase income, reduce spending, or do some of both. And what most people do is do some of both. And that's what we need to do as a country also to get back to some financial responsibility. Now, as I started saying, this article I was reading was kind of discussing how high can the U.S. debt go before it triggers a financial crisis. Well, there's a number of reasons why we're not at a crisis. One I shared earlier. Interest payments for the U.S. government is about 22% of revenues currently. Although not ideal, that is manageable. Those are manageable levels. Good rule of thumb is anything over 30%, you can't qualify for a mortgage because your debt to income ratio is too high. You could apply similar types of things to government debt. Although the government has a little bit more flexibility in terms of printing money, they can print more, but then that does lead to more inflation, so that's not necessarily a great option. Again, their best solutions is increasing income and reducing expenses, just like any household or business would have to do. Are we at crisis levels yet? No. 30% is sort of the good measuring tool, and Moody's recently has projected that at current spending levels and interest rates and everything that's going on, we will probably approach that 30% level in 5 to 7 years. But here's another thing to understand about U.S. debt versus debt of other countries. The U.S. is still, despite all the challenges that we have, still the reserve currency of the world. The U.S. dollar is dominant in international finance. There are other countries, there's efforts through BRICS and things like that to reduce that dominance. Some of that may be successful, but will take time. Warren Buffett himself said, as many challenges as we have as a country, what other option out there is better? Are you going to invest in China? Probably not. They got a whole lot of economic problems that are far worse than the United States, frankly. So does Europe. Their bottom line is, despite our problems, there are not many good options, other options out there. So that benefits us certainly. And the other point is, despite the challenges we have as a country economically, the U.S. still is about 50% of world GDP. Although we may not be in the dominant position that we were after World War II, where it peaked out at about 70%, partly because Europe and Japan were devastated from World War II, we're still a very dominant player, and that, although could change over time, is a long, slow demographic process that occurs over decades. My point is this. If we get into financial issues or financial crisis, the United States that is, it's still the strongest major economy and currency in the world. Pretty much every other country in the world would have already gone into economic crises before the United States will. Therefore, we'll have plenty of notice. It will become obvious. It will not. Am I suggesting we continue going down the path we're going? No. Obviously, if we continue down the path we're going, at some point the U.S. is going to go into a financial crisis. The analogy I like to use is we're on the Titanic. We see the iceberg. We know that if we continue on the path we're going to hit that iceberg. We have time to turn the wheel and avoid it, but that time window is quickly running out. The question is, are we going to turn the wheel? There are many things that can be done in the meantime. I've shared this so many times, the lack of financial responsibility of governments creates an opportunity for us as individuals and investors. One of the most obvious things that's going to be happening going forward as our government addresses these financial issues or not, we voluntarily fix the problem or eventually will be forced to fix it through a financial crisis. In the meantime, over the next likely 5 to 10 years, is most experts' best guess, interest rates will continue to be strong, might even rise. Interest rate sensitive assets will thrive. This is why many are calling this the golden age of fixed assets. Insurance company dividends, annuities are already at or approaching 40-year highs. It's the best we've seen in a generation and will likely continue to do that until the federal government addresses their debt issue. Many people are picking on the Federal Reserve. And I'm not the biggest fan of the Federal Reserve either. I think there's some very strong reasons why the Federal Reserve is holding firm and not reducing interest rates. I'm encouraging you to stay tuned in the next segment. I'm going to share some of the reasons why I believe that to be the case.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. The last segment I was discussing how high can U.S. debt go before it triggers a financial crisis. And the long and the short of it is, although we are clearly on a unsustainable path if nothing changes, if we don't increase income and or reduce spending as a federal government, we have not reached crisis levels yet, and we're probably most likely 5 to 10 years away from that based on best estimates. But I finished up with a thought regarding the Federal Reserve. Many people are really pounding on the Federal Reserve to reduce interest rates. And although I am no fan of the Federal Reserve, I think they have very valid reasons to stay put, as they have stated many times, higher for longer. And one of the primary reasons involves the debt, the higher interest rates that are being demanded by bond buyers because of the record levels of debt that's being sold by our federal government. It's the bond market that's driving the show here. See, in the past decade or so, the stock market was really the story. We saw tremendous returns, historic returns in the stock markets and real estate for that matter. And those were primarily due to the low interest rate environment, easy monetary policy that the Federal Reserve kept in place for most of the past decade. Easy money, cheap money to borrow, allowed businesses to expand, grow inexpensively. It inflated asset prices, both stocks and real estate prices. I've seen charts where a $400,000 house, for example, with a 3% mortgage is worth only about half that with a 6 or 7% mortgage. Interest rates have a huge impact on real estate values, asset prices in the stock market, and a low interest rate environment benefits both of those stock and real estate markets in a big way. Higher interest rate environment, higher for longer. The bond market is now driving the show. The bond market is far larger, 3 to 4 times larger than the stock market. It's been quiet most of the past decade because of the low interest rates, now driving the bus. Federal debt is causing higher bond yields or bond interest rates, and this is affecting the banking industry, interest rates, the Federal Reserve, all of that. I don't think they can offer much lower interest rate than what bonds are offering, because if you were an investor looking for cash flow returns, which many insurance companies, banks, pension funds, if you can buy a 30-year bond at 4.5% or 5%, why would you invest in a mortgage-backed security, for example, for anything much less than that? You wouldn't. In fact, a mortgage-backed security, the mortgage rate is not based on bank rates. The mortgage rate is influenced far more by the 10-year bond yield. Typically, 30-year fixed mortgages are about 2 to 3% higher than the 10-year bond. So if a 10-year bond's offering 4%, you're going to see 6 to 7% mortgages. And that's where we're at right now. Because again, put yourself in the investor's shoes. You're a pension fund or an insurance company, a bank, whatever, and you're looking to invest in cash flow assets. Those assets that generate cash flow. That's what those types of investors, large institutional investors, primarily focus on. Now, when you take a mortgage, you're borrowing money. Well, that money has to come from somewhere, which means there's an investor on the other side providing the money. So if you're that investor, that pension fund, for example, if you can get 4% on a 10-year bond, which is considered a lower risk investment than a 30-year fixed mortgage, the reason being institutional investors look at risk avoidance. Unlike most retail investors who want to maximize returns, most institutional investors they're looking to minimize risk. They have plenty of money. They just want a decent return on it safely. And if they can invest in something that generates the income they need, they're good. They're satisfied. And generally speaking, a treasury bond is considered a safer investment in the investment world than a mortgage because the treasury bond is backed by the full faith of the government, while the mortgage is backed by real estate. And although real estate is considered one of the safer investments out there, treasuries are considered even safer than that. You may agree or disagree with that point, but that's how the investment world looks at it, the institutional investment world. So if they can get 4.5 on a 10-year treasury, that's to them from a risk standpoint equivalent to getting 6 to 7% in a mortgage-backed security that they're going to provide the money that you're borrowing. As long as the 10-year treasury is floating around 4 to 4.5%, you're not going to see 4 or 5% mortgage 30-year fixed mortgages. It ain't going to happen. The money flow, the investors are not going, they're going to look at that. They're going to say, that's not enough of a return for me to mitigate the risk. They're going to demand the 6 to 7% return. That's what's going on. That's why we're going to see higher for longer. This is why the Federal Reserve can't artificially reduce rates like they did most of the past decade, because the bond market is saying, banks could offer a lower interest rate. The problem is there'd be no investors to provide the money for the mortgages. So they wouldn't be able to sell them because the money's going to flow to the treasury bonds. So where it used to be a matter of watching the Fed drove the bus most of the last decade. And by artificially pushing interest rates to a low, pushed asset prices up like stocks and real estate. It's now the bond market that's driving the bus. And until the federal government reins in spending, gets their debt under control, and stops selling record levels of bond, nothing's going to change. That's why we're so confident about dividend rates, annuity returns, which are at or above 40-year highs, are going to continue to do so, and if anything, continue to rise. Again, this isn't me saying this. This is J.P. Morgan and BlackRock and Vanguard analysts, and you name it. They're all saying that dividends, annuity returns, fixed assets are going to continue to be on the rise for the next 5 to 10 years. This is the golden era of fixed assets. There just hasn't been a better time, literally in a generation. And that's why I say the federal government's lack of responsibility creates an opportunity for all of us. And I like this article entitled, "Greed is Overlooking a Rare Opportunity in Risk-Off Assets." See, many individual investors are still looking to maximize returns, and they've been so used to those returns coming from the stock market, and they did for much of the last decade. It's a comfort zone thing. It's a human nature thing. They've gotten so used to that being it's all about the stock market and nothing else, not realizing that the underlying game has changed. As I stated earlier, it's the bond market driving the bus now, not the Federal Reserve. That's why they're stuck. That's why they're stuck in a position where they're struggling to lower interest rates. They can't because there's too much federal debt, too much bonds being issued and being sold, which is driving interest rates up. By the way, it's going to continue to drive borrowing costs up. So you spend any money to borrow on anything, it's going to be higher than it's been for the past decade plus, and likely will continue for the next decade plus. Again, that's assuming the federal government gets their spending under control. So far, there's little sign of that. But what I don't think a lot of individual investors realize is how significantly the landscape has changed. Everything under their feet is different, and many people still don't even realize it. An example I use is most people knew that 3 years ago you could get a 30-year fixed mortgage at 3% or less if you had good credit. Those don't exist anymore. They're double that or more. And that's with good credit. And trying to help people understand is that was a once in a generational opportunity. That was the lowest interest rate environment for the longest period of time in the history of the United States. We have never experienced anything like that, and it changed the game. It changed investment strategy. It changed the stock market. It changed the real estate market. But human nature, human beings are slow to react oftentimes. It's slow to realize that the game, as much as the game had changed in the favor of asset values to rise, stock and real estate market, because of the low interest rate environment provided by the Federal Reserve, it has changed that dramatically the other way. The pendulum has swung about as far as it ever has one way, and now it's swung about as far as it ever has the other in the history of the country. These are tsunami level changes. And they're not changing anytime soon back. For the stock market to have returns over the next decade we saw over the past is beyond negligible. It's nearly impossible to see anything close to what we saw in the last decade. Again, this isn't me saying this. In fact, those same analysts from JP Morgan and Vanguard and BlackRock and others, there are competitors, folks, saying this. This isn't fun for them to say it, but they are. Many of them are also stating that fixed assets will likely outperform the S&P 500 over the next decade. A couple of years ago, that would have been blasphemy. That would have been unimaginable. But that's the territory we're in now. That's the economic environment we're in now. I can't say this strongly enough. If you haven't reduced some of your risk, it's time. If you haven't looked at fixed assets recently, you might be shocked with no downside market risk. Why would you put assets at risk when you don't have to, and you're likely to see similar, if not greater, returns over the next decade? If you want more information about this, contact me at yourpersonalbank.com. And I'm going to share a few more thoughts about how seismic of a change this economic environment we are now in will likely affect us going forward for the next decade.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So I'm seeing a number of articles coming out discussing what it takes for the average family of four to live comfortably in the United States today. Things have significantly changed. Interest rates, inflation has taken a real hit on a lot of people. Grocery prices alone increased over 30% over the past 4 years, for example. It turns out that the U.S. median household income, based on the most recent Census Bureau data, is about $80,000 a year. But as this article stated, living comfortably means having enough income to dedicate half of your income to necessary costs, necessary living expenses. That's food, clothing, housing, that kind of stuff. 30% to discretionary ones, so things that you don't necessarily need but want, and 20% to debt payments and savings, commonly known as the 50-30-20 budget. Well, it turns out for the average family of four to be able to accomplish that in the most expensive state in the U.S., happens to be, surprisingly, Massachusetts, that family needs to earn $300,000 a year. If you take a state that's with a far lower cost of living, Mississippi, that number is $186,000 a year. Now, in both cases, the amount of income it requires for a family of four in the United States to live comfortably is far greater, more than double of the average income. So clearly, far more than half the people in this country are nowhere close to that. And that's why this other article discusses where Americans are losing spending power and most cannot afford to live at what's called a minimal quality of life. According to some of the most recent studies, 60% of households' income fell well short of the threshold of what they considered a minimal quality of life. And this is because medical expenses have increased over the last several years 300% on average. Travel expenses are up 170%, rents up 130%. Even higher education went up a little bit, 101%. Even higher education went up 107%. And as they point out some of the solutions, these are seismic changes. You often hear about, well, you need to stop going to Starbucks and buying your coffee. That's not going to make enough of a difference, folks. These seismic changes of the economic situation, record levels of debt, well over half of Americans not earning anywhere close to what is considered a comfortable lifestyle. You really have to look at, as I state all the time, increasing income, reducing expenses, serious expenses, or doing some of both. Getting a raise, increasing your business income, those kinds of things can be solutions. Taking a side gig, perhaps, working overtime. These are all things that can be done to raise income, and many, many households need to take a serious look at that. One of the things I share with people all the time when I look at their financial picture is I'll say, do you want me to tell you what you want to hear or what you need to hear? And the beauty of that is many of the folks that have taken the advice I've given, it isn't necessarily a permanent change they've had to make, but perhaps a temporary change for a period of time. They've been able to right the ship and improve their situation. But as I always say, you want to address both sides of the coin. You want to see if you can increase income and reduce expenses. But there's a third option. The personal bank helps you earn interest on income you spend so you can actually keep some of that, which means your money goes farther. There's never been a more important time to have a personal bank policy help you through the economic landscape that we're dealing with. And I guess I reject this article I saw from Yahoo. It said you should be thrilled with a mediocre life. I'm sorry, I'm not thrilled with a mediocre life, and I'm not ready or willing to accept that. But the reality is the majority of Americans, again, are not seeing their income is not keeping up with their expenses. And that's, again, why we have record levels of debt. And that's only going to last so long. So if you're one of those people and you want some advice, contact me at yourpersonalbank.com. If you're willing to be coachable and make some changes, you can do so. You can dramatically turn your financial position around in a fairly short period of time. It can happen a lot quicker than you think. And again, your personal bank can help accelerate all of that. It can accelerate debt payoff. It can accelerate income generation. It also can accelerate returns on investments. So it can do a lot of things for you to help you get into a better financial position. But if you don't do anything, put your head in the sand or keep going down the same path, the definition of insanity is doing the same thing over and over again and expecting different results. I mean, it's no secret. Home affordability is at historical low levels. For quite a long time, we were told that home prices were going to stay high because of lack of inventory. Well, in major parts of the country, particularly the South and the West, inventory levels have risen at or above pre-COVID levels. Yet, buyers are still remaining on the sidelines. That's because the prices of homes have increased upwards of 50% the last 4 years or so, and interest rates are more than double, which means the cost of a mortgage is triple of what it used to be approximately 4 years ago. This dramatic historic increase has priced a majority of Americans out of purchasing a home. Again, owning a home is one of the all-time high, most expensive periods of time. And so their solution, reality, is renting. It's far cheaper to rent than own. And it's one of the most dramatic differences we've seen as long as they've been tracking the numbers. again, there's things you can do about it. There's things I can help you with, give you some direction, and put you in a different position. But you have to reach out to me to get that help. Yourpersonalbank.com. Be happy to do so. Now, different people are in different positions, and I like this article where it discusses there's 6 levels of wealth, and they were focused on retirement age Americans. So the advice or the direction of what you should do varies quite a bit depending on where you fall on this pyramid, as they call it. They broke it down into 6 levels. They have the financially vulnerable, and those are folks that have a household network of under 70,000. They've got some financial challenges and major things need to change for them to get into a better position, and that's about the bottom 25% of retirees. The lower middle class have a household net worth, according to this article, of between 70 and 400,000. That means they're in the lower half, but not the bottom quarter. This group that are in the lower middle class, again, total household net worth, that's again what you own minus any debt, between 70 and 400,000. You may or may not be financially vulnerable, but you're far from a comfortable retirement. You're going to have to stick to a tight budget probably, but there's definitely things I can do to help you enhance. One of them is to increase your returns, get positive arbitrage, positive cash flow on your money. These things are super important for somebody who's in what they consider the lower middle class or are somewhat financially vulnerable. To be solidly middle class in America at retirement age, to be within the 50 and 75 percentiles, you need a total household net worth of between $400 and $1.1 million. So 400,000 to $1.1 million puts you in the upper between 50 and 75 percentile. Typically, you're going to have a more comfortable retirement. But as they point out, if your net worth is trapped mostly in an illiquid asset, such as your house or a private business, you're going to have to find ways to create liquidity. Your personal bank is one of those that can do that for you and help supplement retirement. And as this article states, even if your assets are liquid and easily accessible, you probably need to have a somewhat stringent budget and conservative spending habits. Again, this is for someone at retirement age between 400,000 and 1.1 million in net worth. Now, your upper middle class, you're in the top quarter of retirees in America. You're at 1.2 million to 2.9 million of total net worth. You're officially in the upper middle class. You may have even achieved your magic numbers many people look at for retirement savings. And a comfortable lifestyle is fairly certain. Although inflation, excessive splurges, or market volatility could erode your financial security quite quickly. So even if you're an upper middle class, again, 1.2 million to 2.9 million, based on the latest numbers, you still should have a significant portion of your assets insured, guaranteed, safe. This is the golden era of fixed assets. An annuity can be one of the best tools for you at this point to make sure a portion of your portfolio doesn't disappear in a market downturn, and in fact can continue to keep contributing retirement income to you or supplement retirement, while perhaps the remainder of your portfolio that may have suffered can be given a chance to come back because you're tapping the fixed asset side, the guaranteed side that didn't lose market values. So again, it's smart to diversify, particularly if you're at or near retirement age or in retirement. Best time in over 40 years. If you haven't looked into an annuity in the last couple of years, or if you have one, by all means, contact me, yourpersonalbank.com. I dealt with 2 clients today alone where we were able to take old annuities they had that were over 2 years old. Some of them even had penalties. And the guaranteed returns on the new annuities, were double of the maximum potential return they could have received on the old ones. There's no cost or fee or any tax to roll these over or transfer them over. So it was a no-brainer, and it enhanced their financial position. To be an affluent household, top 10%, you need 2.9 million or more in net worth. And as this article points out, you can afford a fairly lavish and financially unrestrained lifestyle. you're in good shape financially. Again, diversifying still makes some sense, reducing some market risk depending on your risk tolerance, but you're in pretty good shape and don't have a whole lot to worry about. The top 1%, you have to be over 20 million. The ultra wealthy, that's another whole category. Your personal bank can come into play there because it's tax free, so you can reduce taxes. Someone with that kind of assets definitely has some tax challenges in most cases. So we can help them out there. So regardless of where you fall on this pyramid, as they call it, the 6 levels of wealth for retirement age Americans, there's a tool, there's a solution that can enhance, a financial tool that can enhance your retirement, enhance your financial picture. Again, whether you're nearing retirement, at retirement age, or already retired, I've got some things that'll really can improve your situation. Contact me at yourpersonalbank.com. It's a golden age of fixed assets. There hasn't been a better time in over 40 years. Encourage you to stay tuned next week to Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.